Stock market bubbles are characterized by rapid and unsustainable increases in asset prices, followed by a sudden and dramatic collapse. Here's a concise overview of the science behind stock market bubbles. Psychological and behavioral factors. Bubbles often begin with investor optimism and herd mentality, fueled by expectations of continued price increases and fear of missing out, FOMO. This leads to speculative buying, pushing prices far beyond intrinsic values. Market dynamics. Bubbles are driven by a feedback loop of rising prices attracting more investors, further inflating prices. This positive feedback reinforces the belief that prices will continue to rise indefinitely. Valuation disparities. As prices detach from underlying fundamentals, earnings, dividends, etc., stocks become overvalued relative to their true worth, creating a bubble. Market participants. Bubbles typically involve participation from retail investors, institutional investors, and sometimes even sophisticated market professionals, all contributing to the frenzy. Media and information cascades. Positive news coverage and widespread optimism perpetuate the bubble, while negative news or skepticism may trigger its collapse as sentiment shifts. Bubble bursting. Bubbles burst when investor confidence wanes, triggering panic selling and a rapid decline in prices. This can be catalyzed by external shocks, changes in economic conditions, or regulatory actions. Historical examples. Famous bubbles include the dot-com bubble of the late 1990s, where internet-related stocks soared before crashing in 2000, and the housing bubble in the mid-2000s, driven by speculative real estate investments. Economic impacts. Bursting bubbles can lead to significant economic consequences, including wealth losses, financial instability, and broader economic downturns if the bubble was large enough to affect the overall economy. Lessons learned. Understanding the psychology and dynamics of bubbles helps investors, policymakers, and regulators recognize signs of overheating markets and implement measures to mitigate risks of future bubbles. Research into the science of stock market bubbles continues to explore factors contributing to their formation and strategies to prevent or manage their impacts on financial markets and the broader economy.